Hi, this is Jim Cunningham, and we're going to talk about shifting your real estate strategy, how to invest in real estate outside of California. So a lot of people, they say, I'm getting out of California or I'm moving my real rentals out of California for whatever reason. Primarily, spoiler alert, the income can be a lot higher. We've got Jeff Lawson, who's a real estate broker and real estate agent, and is the one who's instrumental in helping facilitate these type of structures. So very excited to have Jeff here joining us today. And are you, really the question is, are you thinking about getting rid of an investment property and a 1031 exchange? So a 1031 exchange, what is that? You own real estate, you sell it. Instead of paying the capital gains tax when you sell it, you reinvest that property into a like kind property, which is basically rental property that's real estate. So very important. There's a whole bunch of rules on there. We're going to kind of briefly touch on them. But the next question is, when you go to replace that property, are you replacing it with another property in California, or are you thinking about going outside of California? And for a lot of people who have a depreciated asset, maybe you bought that office building or commercial property or rental. A lot of our clients bought rentals over the years, and these have been fully depreciated after 27 and a half years. You're kind of losing that depreciation. Tenant, landlord, California, Jeff, very landlord, very landlord unfriendly, tenant friendly. So if you've ever had a tenant who stops paying their rent and you go to serve an eviction on them, they say, "Oh, well, there's black mold in the unit." Well, yeah, because you're a pig and you're trashing the unit. That's where the black mold's coming from. It's not my fault as a landowner, the landlord. That's a whole next level lawsuit litigation. Deferred maintenance is a real big one. And my parents have owned rental property for 50 years. And yeah, when it's that third kitchen you're replacing in your 80s on that unit you've had for 40 years, you kind of get tired of that because it's, Jeff, it's getting really expensive to fix stuff now, right? Inflation has really kind of gone nuts, especially in construction. Also, low profitability. California, as we've said, if you've watched videos in the past, I view California, it's a great place to live. It's a great store of wealth. People from all over the world want to be in California. They certainly want to be in the United States, and definitely California for a variety of reasons. So many of these properties have corresponding low net income numbers. So if you buy that home for $2 million in the San Francisco Bay Area, you might be renting that for $4,500. But when you look at your net income, you're closer to 1.5% or 2%. So not great from an income producing standpoint. If you're thinking about investing in real estate and getting started, a lot of our clients reach out to us. They say, "Jim, I make a lot of money. I'm a W-2 worker. The only weapon I have against the tax man is real estate or other types of investments, but real estate's one of them." And real estate, by the way, is subsidized in large part by the United States government. So this concept of depreciation. So if you buy something, if you buy a residential rental, the government says, in 27 and a half years, that thing is going to be fallen down. There's going to be no structure. There's just going to be dirt. So all those improvements are what we call depreciated. And what happens is they give you an income tax deduction of 1 divided by 27 and a half, kind of each year. So you're getting maybe 3% each year of an income tax deduction. And that's kind of why I say the government supports it. So investing in California, certainly if you are looking to come into investing in rental property and want income, right? So capital appreciation is a different thing. But if you're looking for a source of income, investing in California can be less attractive than investing in outside of California. That being said, maybe California has a higher potential for capital appreciation. So really it's a balancing of what really is suitable for your particular needs. So if you're watching this on YouTube, we're doing this live. We release these on YouTube every Thursday at about 6 p.m. Pacific time. Please subscribe to our YouTube channel and click the thumbs up. And also you can share that with your friends. You may want to share it with your family. And so a lot of people have shared it. We have recently hit, a little shameless plug, 1 million views on our YouTube channel. So very, very exciting. And I'm Jim Cunningham. I'm a partner at Cunningham Legal. We have 30 years. I have 30 years experience. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities, and insurance licensed, and a pilot single engine land. I'm also a real estate investor myself. So my wife and I have a multi-unit building, and so I'm drinking from the whatever what do you call it? Drinking from the pond water? I don't know what you call it. So, Jeff, we have with us 20 years experience selling residential and commercial real estate. He's an expert in managing and maximizing returns on investment properties. He has nationwide access to CoStar, which is a very robust, expensive platform that's for the commercial real estate space. And it's kind of a joke because CoStar interview, they might ask you, Jeff, what were the terms of this deal? And you give them all this information, then you have to turn around and pay them to use their software. So kind of good for CoStar. And you're specifically focused on what we call off-market multifamily opportunities, which you'll kind of walk through that. And you have relationships with brokers, property managers, and banks in the areas that are more attractive from an income standpoint than California. So this is very important to understand the distinction. You know, if you want more income from your property, you can either raise rents, but of course in California you're constrained, and you know you can only raise rents so much even if we weren't constrained. It's not like you can take off a door and sell it and get some money, right? So for people who say, gee, I would like more net income from these rentals, those are the people who are looking to move outside of California. And you have the ability to increase equity, cash flow, as well as tax benefits. So if you have that depreciated property, maybe it's worth $1 million. You then trade for a $2 million property and take on a little bit of debt. You're getting more basis. And that's why we're talking about, certainly more depreciation, more tax benefit, but also the tax deferral. So I'm a lawyer and my lips are moving and I say there's no attorney-client relationship. You're not a client by me talking to you. So this is not an attorney-client relationship. The bottom line is don't watch this video and go out and do a bunch of legal stuff. You definitely want to speak with a savvy lawyer, and we have a whole bunch of them at our firm. And again, we have offices in Northern and Southern California, as well as virtually most of my appointments basically are by Zoom. So let's talk about the appeal of investing outside of California. So Jeff, why do people who may choose to continue to live in California, and we cover that in other webinars, why it's a great place to live. And I know you're in Orange County and I'm in the Bay Area in Northern California. But so why do people want to move out of California? Tell me, just kind of walk us through and help us unpack that.
Sure. Jim, thanks for having me, and I appreciate it. And everybody that's on the call today, very much appreciate you taking the time to take a look at what we can offer. There's a bunch of reasons why people are moving out of California specifically for multifamily investment properties. As Jim had mentioned, the big thing is the laws in California are brutal on landlords, trying to get people out of a property if they don't pay. Also, what are you going to pay for a unit? We're doing deals in different states where we're paying a fraction of the amount of money for the actual real estate. So there's a bigger spread between what you can buy the property for and several years later what you can sell the property for. I've had clients that have sold a beach house in California and then purchased 100 units in another state, and then been able to use the cost segregation and other tax savings vehicles to really get a bigger lift on the value of their money.
Yeah, so a lot of reasons, and I think everyone might have their own reason for moving out. I know when we meet and typically, so somebody who's had property for a long time, when we typically meet with those, by definition, if you've owned a property for 27 and a half years, you're going to be a little bit older, right? And we meet with those people and they say, that the maintenance, I find I'm getting maybe 1.5–2% net income when I look at the value of the property, which really is really not that much money when you look at it, versus selling that property and instead of getting 2%, kind of stepping up that cash flow. And we'll talk about numbers in a little bit, but this is really exciting for a lot of people where they can sell that property, not have to deal with the leaky faucets and plugged up toilets. There's property management in place, and we'll talk about your role in that, but you're really not having to deal with anything as the landowner, right? As the investor. And that's something that you're helping, helping the investors out with yourself. So let's look at the Southeast. So when we talk about the Southeast, and as we're getting ready for this, I was trying to do an acronym with Oklahoma, Texas, Louisiana, Arkansas, Mississippi, Tennessee, and Florida. And I came up with like FLOMOT and something FM, and I don't have them in front of me, but I think it was LOTA FM, LOTTA FM, or FM LOTA. The point is, there are states that are in the Southeast, not California, and they're kind of grouped geographically with Florida as the outlier, but these have lower prices when compared to the rents, right? and this combination of very landlord friendly laws. So maybe walk us through some examples. I mean,
Sure.
give us some color on this.
Absolutely. So, as somebody that's done real estate in California for 20 plus years, and I've had investment properties, I've had clients with investment properties. And if you've got a tenant that's not behaving, or if you've got a tenant that's not paying their rent on time and you need to get into eviction, it could be 3 months, 6 months, a year until you're able to get them out of the property. And let's say it's a single family property. Now you have zero income, right? And so a lot of that centers around, well, what are the laws in these different states and how long does it take to actually get a tenant out? And I will tell you, in Oklahoma and some of these other places, and this is going to shock you, but a week, 2 weeks under an emergency
Whoa.
eviction. So, so this kind of stuff is very helpful. And so it's really important to understand what those laws are so that you can get the property performing as best it can. Because look, owning multifamily, not everybody's going to pay on time. You
Yeah.
want great tenants, but when that doesn't happen, are you set up an environment that's going to protect you as an investor?
Yeah, and I'll tell you, I've just the feedback I've gotten from clients is most people, frankly, most people pay their rent, right? Most people, I would say, and I think we were talking about this a while back, but sometimes it's people that, oh no, this was a client I was talking to. They have a beautiful home in Marin County. They're renting out for a very large amount of money. And they say those, and they have a lot of other multifamilies. The people they have the problems with the most are the people with a lot of money who come in and rent a single family and pay a lot of rent. Those, the people who are renting the one bedroom in the studio, you know, they're making their rent payment, but oftentimes it's the people who are wealthier with the higher nominal rent that sometimes are the most problematic. But I would say that the landlord tenant climate in California, just observing what's happened, certainly through COVID, but what I think we're seeing in California is a even more increased government involvement on the state and local level into housing and housing rights and being concerned about the unhoused, which I am. I see, you know, I live in an urban environment. I see homeless people, and it's heartbreaking every time you see somebody who's unhoused. And the government are passing more laws, more rules to make it harder to be a landlord in California. So if that's something you can stomach, then you can stomach it. But if you say, you know what, this is just too much to take, I don't want to be underwriting this government policy, I want to get out of here, that's what we're talking about. We're talking about selling those properties in California and moving them to a different area, a different state. So maybe walk through some ideal criteria.
Sure. Well, how I kind of came up with this strategy, Jim, was I went to a lot of different markets around the country. And I said, well, where do you get the best chance for success based on the size of property, based on the vintage, what you can potentially get as return? And so it kind of naturally morphed into a particular geographic area and a particular vintage, if you will. So and these are what are called value add properties, where some of them may need some work. Think of it like a large flip. So when you do a flip property, you come in, you purchase it, you do some work to it. And so what's the value for an investor? Investor is going to come in and they're going to say, maybe management isn't optimized. Maybe it could be fixed up and we could charge more rent. Maybe we can lower expenses. And this is how people that invest in multifamily take it from what they purchase it at to a higher price, a better performing asset, and then sell that through a 1031 exchange, which I know you'll talk about later. But after doing a bunch of these deals, it kind of settled in on a specific criteria. And why 50 to 250 units? This is really what I call below institutional. This is where a single investor could come in, have enough money to put the down payment, fund the accounts, pay for the repairs, get property management set up, these sorts of things, and then take a distribution and have someone like myself involved as an asset manager that would help them with the acquisition and placing property management, placing the debt, and getting the whole property up and running once they purchase it.
So a wise, wealthy, old, I should say, client, meaning elderly client, told me many years ago. I asked him, I mean, he had amassed a very large portfolio of property. And I asked him, Mr. Client, what advice, I mean, you know, what advice do you have when it comes to real estate? He said, well, something to understand from the get-go is there are no deals in real estate. And I asked him, well, what do you mean? He says, everything trades at market value. And I think that's largely true. Is, we have a robust marketplace in the United States when it comes to real property. He said it's what you do with the property after you get the property, right? Where you have the value, the value add. So I remember talking to you and getting ready for this. You mentioned that you have an apartment building where they weren't charging a pet deposit of whatever. I mean, what was the pet deposit? I was zero
Zero.
before, but what is it? What did it become?
$300 a unit.
$300 a unit plus additional rent for the pet, right?
Correct. And then so you have, I don't know, 100 and something units with 80 people having pets. And so there's a lot of ways there that you can recognize new income where it was a mom and pop owner, not using professional property management. And you come in and you create operational efficiencies and you look for all the ways of things that not only were they not charging, but keeping up on late fees, doing all the sorts of things where that's where the real profit is looking at the way that it's run versus the way that it should be run.
And so and I mean, you might think, well, gee, is it right to charge a pet fee? The tenant said, well, it's about time you charge the pet fee because you weren't charging it, because like all my friends are paying this fee. And something that's very important to understand, it is not just the incremental rent you get. So if you have 80 people paying $50 a month, that's what I do the math on how much it is per year. But this is very important. There's a multiplier effect when it comes to valuation. So if you can get another $100,000 per year in income on a property, that increases the value of the property by about $1 million. So it's about a 10x multiplier-ish. I mean, conservative, right? So the more income you can get, the better, because a buyer, when they look at a 50 to 250 unit apartment building, they're looking at something called debt service coverage ratio, which means how much income is coming out of this property, and is that enough to satisfy the debt and the expenses and all that other stuff. So broadly speaking, is the more income you have, the higher the valuation, right? Because the more you can borrow. So it has a multiplier effect. So really pay attention to rents. Now, if you have a single family, it's not, I don't really think that's an issue. They're probably looking at the cost and some other factors. But when you get into these, the 50 to 250 unit space, but it's big enough to benefit from enhancing the value of the property through increasing the income on the property, but small enough where the big institutions aren't looking at this and they're not competing. So it's kind of in this little gap of institutional and then smaller investor. But I got to tell you something, Jeff, if I bought a 200 unit apartment building in Oklahoma, am I collecting the rent? I guess you're going to talk about that. What happens? But
Yeah.
again, let's talk about the appeal of investing
Yeah.
in California.
So there's so how this was really created was I had clients that would have big vacation rental by owner in San Diego, maybe a $3 million property, and then I would look at their return, and they'd own the property outright, and they're just making a fraction of what they should be making, and so they would take that money, or they would sell the property, they would take that money, they would move it into another state, buy a large multifamily, we'd put in professional property management, and then everything just happens for them and they take a distribution. They're given all the financial information. They're updated on what's happening in the property. They're welcome to come visit it, but it's basically managed for them. So they're getting all the benefit of that without having to be so hands-on about it.
All right, let's take a couple of minutes to answer some questions. Chuck asks, where are you located, Jeff? Orange County, right?
Correct.
Joseph did the acronym, a lot of AMF, a lot of multifamily. I like that one. Or a lot of FAM, LOTTFAM. I don't know, like the FANG stocks. The acronyms are fun. Rory asks, how do we ensure high quality property management? Poor quality management destroys ROI and cash flow. Rory, 100% correct. Jeff's going to address that. Anonymous asks, would California tax income from another state? The answer is, if you are a California resident, you are taxed on your worldwide income. So if you have income from Oklahoma, yes, you're going to pay it in California. Are there some strategies to defer California state income tax? Yeah. You could set up something in Nevada with the Nevada trustee, but what you're doing is you're deferring the tax. But bear in mind, the idea with investing in multifamily out of state is not only do you have the income, but you also ideally have basis, which means you have depreciation. So, and something called cost segregation, which means that the income flowing from this, although it is subject to tax in California, probably won't be taxed or be taxed very minimally because you have this corresponding depreciation. So we're going to talk about cost segregation, which is a change in the method of depreciation. Instead of 27 and a half years, it's compressed down to 5 and 10 and 15 or whatever it might be. And so that is something very important to pay and bear in mind, because yes, even though you're paying California, even though it's subject to California tax, whether you actually pay the tax is a different story. All right, let's talk about advanced tax strategies for multifamily dispositions and acquisitions. We're going to talk about the 1031. So what is this? I have a rental property. If I sell that rental property, oh my gosh, I talked to my CPA, Jeff, I'm going to have huge taxes. This is terrible. I paid $100,000 for this thing, or 300,000 for this thing. It's worth $1 million. And we have an example on this. And when I pay, I might have to pay 300,000 in tax. It's crazy. So what can I do to avoid this tax? Because remember, income tax and capital gains tax are confiscatory taxes, meaning if you have that taxable gain or that taxable event in a given tax year, you have to pay money to the government. You never get that money back. Social Security taxes and Medicare taxes are what we call social taxes, where you do to get a Medicare and a Social Security benefit, at least in theory, right? You get that back. But remember, income taxes are confiscatory. That money's gone. It goes back to Sacramento and to DC. You're never seeing it again. So the idea with the 1031, again, this is part of the federal and state policy to encourage development of housing and real estate, so that you can sell a property, move to another property, and not realize that gain, but defer that gain. So a lot of specific rules on that you have to follow. And if you slip up, boom, taxes. So it's kind of an all or nothing. So one of the big things in a 1031 exchange is something called a qualified intermediary. So I sell the property, I don't get the check, right? Escrow Jeff doesn't cut that check to me. That money goes entirely to the qualified intermediary, who is, a person, a company. Just a caveat, there is zero regulation on qualified intermediaries. So pick a good one, pick a reputable one, because theoretically people could just walk off with your money. Now, does it happen? Yes. Does it happen with the bigger players? No. And there are big companies that do this. And that would be Jeff, I think that's probably what you do. You go with a more of a bigger company rather than, Bob's qualified intermediary service.
Sure.
To get 100% deferral, 100% of the equity must be reinvested. You have to get a property of equal or greater value. If you have debt on the property, it can complicate things. It can complicate certain strategies. Next week, or we're going to cover in another webinar. And if you're watching this on YouTube, you might have already seen the webinar. But we're going to cover another webinar on a variant of a 1031. But bear in mind that this is a deferral strategy, and debt can complicate things. So this is why you need to visit with someone like Jeff or someone like at our firm to kind of go over what the issues are if you have debt on the property. Certainly if you have debt over basis, right? If you've refinanced the property, taken money out, and your basis is less than the debt that's owed, you got to be really careful with that. So it must be a like-kind exchange and investment property. And there are two stopwatches or two time periods. You have 6 months to buy a replacement property, and you have a 45-day stopwatch that starts and stops to identify another property. So typically you're going to have, if you're going to do a 1031, typically you're talking with Jeff ahead of time to identify the property. You don't want to just, sell your property and be like, hey, Jeff, find me a property. You would want to be investigating this before you close escrow on your relinquished property, right? The property you're selling. So Dave buys Greenacre in 1994 for $375,000. The property is fully depreciated. The cost basis is $100,000. So that $275,000 value in structure is now depreciated down to zero because it's been 30 years. And Dave sells Greenacre and buys a replacement property, a Red Acre, for $1 million. So he sells Greenacre for $1 million, buys Red Acre for $1 million, right? And he's deferred about $334,000 in taxes if he's taxed at the highest marginal rate. Then Dave dies. Wanda, Dave's wife, can sell Red Acre for $1 million free of taxes because Dave and Wanda owned that property as community property for California residents. Again, this is a reason to retire in California. We've covered that on several videos. But one of the great things about living in California is it's a community property state, so that community property on the death of one spouse gets a full adjusted cost basis. Wanda can hold on to that property and start redepreciating the property. So really good. There are 7 community property states in California. Oregon and Colorado are not community property states. So those are the closest states to California that are not community property states. I mentioned there are 2 time periods, 45 days to identify a replacement property. So if you identify a replacement property and you know that stopwatch stops and you go, I don't like it. It's got foundation issues. We're not going to close on that property. Then that stopwatch starts again. And then you have 180 days to close. And don't ever touch the money. I mean, ever. If you do, it's got to go to the qualified intermediary and it's going to blow your 1031. And this happens, Jeff. I don't know if you've seen this happen, but people, they give the wrong wire transfer instructions, right? And it goes to their personal account. Boom. You can't do a tax deferred exchange. So you want to walk through the 3 property rule, the 200% rule, and the 95% rule?
I can, but I think you probably,
Okay.
I'll just let you roll on with this part and then I'll focus on the other piece.
You can identify 3 properties of any price anywhere in the United States simultaneously. 4 or more properties can be identified if the combined values does not exceed 200% of the property. And then the 95% rule, you can identify more than 3 properties if the fair market value of the properties actually received by the end of the exchange period is at least 95% of the potential replacement properties. So you're not here to learn this stuff. I'm not here to teach you this stuff. I'm just here to let you know this is complicated. And this is why you want to go with a really good intermediary, work with your broker, work with someone like Jeff, because if you don't, you might inadvertently screw up and end up not being able to effectuate your 1031 and end up with a hefty tax bill. And you might have already bought the property. So you might end up in a situation where if you don't follow all these rules, you end up buying another property, but it doesn't qualify for the 1031. And so now the money that you otherwise would have had to pay the taxes is now in the property, and that money's going to have to come from another bucket someplace else. So new asset value must be greater than the relinquished property. The cash invested in the replacement property must be greater than the cash received from the relinquished property. So you're kind of moving up. And the debt on the replacement property must be greater than the value of the debt on the relinquished property. So what are like kinds? If you have a rental property, let's say you've got that house in Santa Clara, right? Or Sunnyvale that is worth a lot of money. And you go, I should have bought 2, right? 30 years ago. Who would have thought it would have gone up that much? That's residential, single family, multifamily, industrial, commercial, double, triple net lease, a property under a double or triple net lease, and professionally managed portfolio, which is something we cover in other webinars. But I would say most of our clients, Jeff, it's going to be single family and residential property that might be multi-unit, right? So might be like a duplex or a fourplex, or certainly if you have a bigger apartment building in California. All right, investing in real estate with an asset manager, which is Jeff, that's you.
Yeah.
You're the asset manager. So let's say I go, wow, this is great. I want to buy a 100-unit apartment building in Oklahoma. There's no way I'm going out there. I'm managing it. I don't even want to talk to the property management people, because I think the problem with property management is I hope no one is anyone on here a property manager. If you're a property manager watching this, please don't be offended. But property managers are interested in collecting rent, getting their split, and there's no skin in the game, right? They're the only skin in the game they have is not getting fired as your property manager. But they're not, if there's deferred maintenance, or they could judge it up and they could fix things up and maybe get some rents a little bit higher. Are they really paying that close attention to the market? Like, where are rents going, up or down? You having somebody who really is paying attention to it and has a vested interest in it can be better. So let's talk about capital conduit.
So thank you, Jim. So I've been doing this for over 20 years, selling both residential and commercial. And now I've really moved specifically into working with high net worth investors, purchasing and managing properties out of state, because I've just seen so much success there. Not that there's anything wrong with California real estate. I've bought it, I've sold it, I've listed it, I've helped people acquire it. And if it's simply an appreciation play that you're looking for, then California is fine. But if it's really about cash flow, if it's really about deferring the tax and getting depreciation and, basically creating a nest egg for yourself and, monthly income, all those sorts of things, then I believe that the multifamily out of area strategy is best. And so what I've done is I've focused on specific areas, mostly secondary and tertiary markets. The big markets, you've got the guys from New York and other places. They're crawling all over these investments, where I have found in secondary markets and tertiary markets, these properties often get overlooked, but they're right sized for myself and for my clients for purchases anywhere between, let's call it $1 million to $2 million up to $20 million. And so there's a lot of business there, and there's a lot of mom and pop owners who have maybe had it for 25 years, managing themselves, and they're retiring and they want to sell it. And so brokers will come to me with off market opportunities before it ever hits the MLS, because they know that I may have buyers. And, let's face it, brokers, they just want to make their commission, which is fine. And they may not want to go through the whole marketing process. And so most of the good deals never see the light of day. It's all based on relationship.
And some of these deals in working with you, I know we have a mutual client.
Mhm.
Some of these properties have some deferred maintenance. They need money. And sometimes the people, just think if you're a real estate investor and you have a property with deferred maintenance, you're like, I just don't want to put money in the property. Guess what? There are people with big multifamilies out there that don't want, they don't want to, they just want to get rid of it. They don't want to have to dump another, 200
That's right.
grand in property to fix it up, even though that's a huge return on your investment when it comes to occupancy and the rents you can charge and the amenities or whatever it is.
Mhm.
So it's very important to understand that a lot of these properties there maybe a little bit of a diamond in the rough. They need to be judged up, whatever it might be. But that's where the value is. And that was a comment I made earlier with the wise old client who told me that properties trade at market value. It's what you make of the property after where you can add value. So that's really, I think, Jeff, that's your niche. And if the difference, you mentioned the big institutional investors, and we had a question here online where somebody asked, are you going to cover the DST or the Delaware Statutory Trust? And the Delaware Statutory Trust, they're going after, the 350 newly constructed, units newly constructed near the Raleigh-Durham airport, right? These growing areas that are, and new construction, it's been recently occupied, and it's big enough where it makes sense for an institutional level investor. It just doesn't make sense. A $3 million property is not even appearing on their radar screen, right?
Correct.
Like they're not picking up nickels, they're looking for $100 bills, even
Right.
though it may be a good investment for an individual, right?
Absolutely.
So how does walk me through the process? So if I'm a person and I say, "Hey Jeff, this sounds great. I'd like to talk more about it." Uh,
Mhm.
what does this process look like? What am I? So if I say, I do want to sell these couple of properties, and I think I'm going to do it in the next 6 months or
Mhm.
next 3 months or whatever it is. What? And I talk to you. What does that process look like?
Sure. So first, what we want to do is we want to take a look at the actual asset. What sort of income does it produce? What sort of expenses are associated with it? What sort of tax picture are you looking at? Who's managing it? All of those sorts of things, right? So we're gonna do an assessment of that. Then what we're gonna do is we're gonna figure out, okay, well, what would you get? What would you look to replace that so that you're actually improving your situation,
Yeah. So what you're
right?
looking at is somebody who wants to sell. You're
Mhm,
looking at what they have. What
correct.
is their cash flow? So
Mhm,
after all the expenses, what are you putting in your pocket at every
mhm.
month or every year? And is it a good time to sell? Maybe it's not a good time to sell. I mean, I think real estate in California is regional, right? I know it depends, and there are seasons to sell. But so then once you say, all right, it's time to sell this property, uh, when do we start looking at replacement property before we list that property, right?
Absolutely, because ideally what we've done is if we've identified that the client wants to sell and we know that financial picture, I may have a property that they could move into that's off market, do a 1031 exchange where they're deferring all the tax, like you had mentioned, and then buying the replacement property. The problem with a lot of 1031 exchanges, the way that other people do it, is they list and sell their property and then they scramble to find a replacement. And that's a bad strategy, because what they need to do is they need to have a great deal already lined up that's off market, that's locked in, so they know where their money's going and they know they're getting into a better situation. It's a little bit more difficult, but it's a great benefit to the client. And I've seen too many people panic. And I even get those calls, hey, I have to replace my 1031. Well, that was just because of bad planning, right? So if I know about off market opportunities that I can plug them into, I want to have that lined up for the person as they're selling.
Yeah, I'll tell you what, I see this, and I don't. I think it oftentimes depends, and I'm going to say this gently, on where a person is in their stage of life, because sometimes it's hard to have all of these things kind of spinning all these plates at once for some people. And I think that's why it's good to use advisors, to use you, to use your CPA, your lawyer, but really think about this in advance, because we get those panic calls where they say, I'm at day 43 and I need to identify a property or I'm out of it. That's not, if you're watching this video and that's you, I don't think this is going to work. I mean, maybe there's some other solutions out there, but really this is something, if you're a person who says, look, I have this property, I'm thinking about selling it, that's when you want to talk to you and kind of lay it out, right? Very, very important. Um, so then you go through, then you sell your property that you're going to be selling, and then all that money goes to the qualified intermediary. It doesn't land in your own account. Make sure you give them the right wire transfer instructions. Check it 19 times, right? Maybe even get a check and walk it to the qualified intermediary. I don't know, but you're also dealing with, there are a lot of people involved in a real estate transaction. So think about this. You've got, you're going to be talking to your bank about, how much, if there's debt on it, how much do I owe? And then you'll be like, oh, gee, I need wire transfer instructions. If you're not paying attention and get the qualified intermediary wire transfer instructions, it may go to your account. So very, very important. Um, so, and then looking for the replacement property, what are we looking at here? When should we start that process? We start it before we sell the property. How long does it go? What's the typical time from, the first inquiry to you to
Sure.
identifying a property and closing? Yeah.
Well, let's assume that we've got a client that their net equity coming out of a property that they're selling in California or somewhere else is, let's call it $1 million.
Yep.
What we would do is we would want to identify a property that they could move into where they could have enough for the down payment, enough to fund all of the accounts that go along with managing a multifamily property. People don't think about that part, that you've got a checking account for expenses. So you typically want a couple of months worth of operating expenses for that property. Also reserve and replacement, things are going to break, that sort of thing. So what I do is every day, all day, I review packages from brokers with all of the financials and marketing material, and then I present it to clients that are looking to acquire. And so the second bullet there, you see review of due diligence material. So there's something called a rent roll. A rent roll is basically a list of all of the different units, what they're charging for rent, deposit, are the people current? The T12, that's what's called a trailing 12 months. That's all the revenue and expenses on that particular property. So think of it as a spreadsheet that a seller provides that lists out all of that information that then I have to verify. And an offering memorandum typically comes from a broker, which is the marketing material that will talk about the geographic area, the economic climate, the schools, the comps, the rents, all of those sorts of things. So I take all of that and then I underwrite the property. So what I will do is I will run it through my models to see, does this thing actually pencil out? Is it a good investment? Okay. And then if it is, and I present it to a potential buyer, somebody that's done a 1031 exchange, we would then put together a letter of intent. A letter of intent is the basic deal points: purchase price, escrow period, etc. And then once a seller accepts that, then you would move to a contract phase, do a purchase and sale agreement, and then it would work much like an escrow on buying a house, where you would have an appraisal, an inspection, you would have a lender do the loan, and then close, all of those sorts of things. And of course, in that process is the LLC creation. So at that part, it works much like buying a house, but on a larger scale.
Yeah, and it's interesting as you're going through this, I'm thinking how different this is than a residential,
It is
a
different.
family residential, right?
There's similarities, but there's definitely some differences. But
Yeah.
and we can talk later about it. But when I do consultations with clients, or potential clients, I can walk through in more detail all of the mechanics, the logistics, and the flow of it.
I mean, it sounds to me like whether you're buying a multifamily or a business, like these are the same steps you do in acquiring a business.
It is
Really?
buying a business, really,
It,
because
that, yeah,
yeah,
it is. It's
yeah,
like buying a business, right?
sure,
And
sure,
so if that's for you, great. And if it's not for you, then this isn't for you. And then you have the DSTs, you got all this other stuff you can do. And
right.
maybe that's something that's significantly more passive, but the return typically is significantly less. And that's a big deal. And you don't have control. So I would say the two benefits to this is control. You control when to sell the property. You have
Correct.
the opportunity to, as I said, zhuzh it up, fix the thing up, get the rents up, get the value up. And you might do this, I don't know, could you do this every couple of years? Because you got to have minimum
Sure.
2 year hold, but you could just roll these every 2 years, fix them up and sell them to somebody else, get another one, fix it up, sell it to somebody else, and just kind of upgrade as you go. So it's fundamentally different. And we had a question about, are you going to talk about Delaware Statutory Trust? No, Delaware Statutory Trust, that's typically a 9 year hold. You're locked in. It's mailbox money, completely passive. There's an element of mailbox money to this because I know a good friend of ours was going to purchase a property through you, and then his business didn't sell, so he didn't do it. But that was fairly. It can be fairly set it and forget it in terms of the investor, right? Jeff, you're doing the heavy
But
lifting.
yeah, I mean, it didn't matter because somebody else bought it through me anyway.
Yeah,
So on
yeah,
some
right.
of these, I saw it was such a great deal. It wasn't really a matter of what I try and do is focus on quality assets that we can buy potentially under market that I know pencil well, and then plug in the right client that wants to buy it. And what I'll typically do, Jim, is I'll give folks a couple of days to make a decision. And then if it's not the right investment for them, I know that it's a strong asset. Someone else will be waiting in the wings to pull the trigger on that deal.
So, the reason why you would want to have this in an LLC, now, by the way, if you own a property individually and you do a 1031 exchange, you initially have to take title individually. You can then put it into an LLC. So you don't set up the LLC and do the 1031 in the middle of all of that. If you sell that property as an individual, you're going to be the one buying the property, the multifamily as an individual, and then put it into the LLC. Just a very important point. But an LLC is very, very important. And this is really I cannot overstate the importance of this. It contains the liability that arises from that 100-unit apartment building to the assets of the LLC and not your other assets. So if something goes horrifically wrong inside of that LLC, a fire starts and leaps to 10 other buildings, and all those 10 other insurance companies are suing you, right? You definitely want that in an LLC. So it really protects your downside. The other thing is typically LLCs by default are taxed as a partnership if there's more than one member of the LLC, but typically these will be taxed as a partnership. So one of the things we talk about with in tax compliance work is it's good to have a lot of that activity on a separate return, because if your 1040 gets audited, they're not looking at your 1065, right? That's your partnership return. Likewise, if your 1065 gets audited, they're not looking at the 1040. It keeps that activity separate. So if you're watching this and you have multiple entities, you understand why you do this, because you don't want everything lumped into one return if you do have an examination. So I would say it's recommended for residential of 1 to 4. Should you have an LLC, it's recommended for residential on 1 to 4 units, essential for commercial properties and multifamily. So what we're talking about here is multifamily. There are just too many risks on commercial properties. You just don't want to, you want to contain that liability to the LLC. And essential for ranching and farming, gives you asset protection and flexibility in management and distributions. And if you're married, you can have a partnership. And if you're single and have a living trust, your living trust can own 99% of the LLC. You can own 1% and still be taxed as a partnership, even though you're the same tax-paying unit. So the idea is the LLC owns the property instead of you owning the property. The entity, this corporate entity, owns the property, and it contains that liability inside of that property. This does require care and feeding and state and tax filing. So for those of you familiar with LLCs, you know what I'm talking about. We cover this significantly in more depth in other webinars. And just to remind you, we really prefer for the vast majority of our clients, if the property, if you don't have a holding company structure, which we cover in other webinars, if you are owning the shares of the LLC and the LLC owns the bricks and sticks and the dirt, probably going to be taxed as a partnership. So that does require separate filing, and both state and federal if you're a California resident, but definitely worth the price of admission. So this is very important. We had a question on this. If you own property with other people, California has a drop and swap rule, which means best explained by an example. Hal and Paul own HP LLC, which in turn owns Red Acre. Hal and Paul want to split the sheets and effectuate a tax-deferred exchange, a 1031 exchange, selling Red Acre and deferring capital gains tax. So they own it 50-50. They say, it's been a nice ride. We want to go our separate ways. If Hal and Paul transfer Red Acre to Hal and Paul as a tenants in common or joint tenants, and then Hal and Paul do their own respective 1031 exchanges, California will likely designate this as a drop and swap and deny the 1031 as to the California income tax liability. So very important, they would have to do a 1031 exchange on the partnership level and then split the sheets. Maybe the partnership buys 2 buildings, and then you got your holding periods, and there's more complexity to it. But very important, this is something a lot of people don't know about. If you pull property out of an entity and then do a 1031, you have to be really mindful of this drop and swap rule. And then there's the Corporate Transparency Act. So this is the latest in federal law. This is a law enforcement. This is called the Financial Crimes Enforcement Network, meaning this is a law enforcement, part of the government that wants a lot of personal information because they're trying to eradicate money laundering and funding of terrorism. And so, pretty important stuff, pretty serious stuff. For entities created January 1, 2024 and later, you have to, you got to do it right around the time you form your LLC. All entities that have to file, and we have a whole other webinar on this on our YouTube page, but all entities that must file, which is typically smaller companies, less than 5 million in revenue, maybe a couple of employees. Maybe it's just you and your spouse, and you have a partnership, and you own a investment property with Jeff. You're going to be under the Corporate Transparency Act. If you have created something before 2024, the deadline's January 1, 2025, and when we do this recording, we're in May of 24, and I can't believe we're almost halfway through, or a third of the way through the year. Basically, it means now. So if you go to check out our website, we can help you with that. It's really not that hard to do it on your own, but some people just don't want to deal with it, or they have a more complex situation. But definitely pay attention to that. And we will, let's see here. We have an example. I'm just kind of looking ahead on some slides. We have one example to go through, and I think we've talked about this, or have we talked about this?
A little bit, but I mean, I can just briefly touch on it for you if you feel like. So a lot of people may be asking, well, what's my role in this whole thing? Essentially, I work as a consultant on behalf of the client, the investor. So I really kind of quarterback the deal prior to acquisition, both the property selling and buying, working with the broker, working with the lender, the inspectors, appraiser, doing the due diligence on the property, setting up property management, placing the debt, all these sorts of things, and then act as the liaison or the Sherpa, if you will, for the client. I have clients that have never even seen the property. They literally own property out of state. They've never been there. And what I have is an owner's representation agreement. But what it basically says is that I'm responsible for running that property on behalf of the client. So providing them with all the financial information, updates, things that are going on, both good and bad. And then clients can be heavily involved, or they can be, less involved. And I have clients that are very hands-off, that we talk maybe once a month. We do a Zoom call, or we just have a quick conference call to update them on items. And then I also work with their trusted advisors. So these are their accountants, their estate planning attorneys, financial advisors as a group, because we need to provide, information for their tax returns, et cetera. So once the property is acquired, I definitely put together a plan, an executive plan of what are we going to do with this property? How are we going to improve it? What's the strategy with property management, the tenant base, et cetera, as well as coming up with what are our distributions going to be, right? So how much money are we going to realize on a monthly basis, a quarterly basis, an annual basis? That is their actual return. And I discussed the financial updates, summaries, and also making sure that we're in compliance with everything that we need to do, both on a city level, county, state, federal level for the property, whether it be certificates of occupancy. Every state has their different laws. So running a large apartment building, you have to stay in compliance. And then working with the management team and their vendors on making sure that the property is well run.
Yeah, and what I like your structure, which certainly you can talk one-on-one with people.
Mhm.
The when you when the person who owns the property does better, you do better. So, or you
Absolutely.
do right. So you're in it together, and that's the difference between hiring out property management and never going to the building. You don't know what's going on, right?
Correct. And
You have
yeah,
no idea.
that's a big thing, Jim. And because I think that there's a lot of people that own investment property and they trust property management. Property management serves a function, but unchecked, it can be chaos. And so to have someone that can audit them, can keep an eye on what they're doing, can direct them. So essentially, the property management companies work for me, and I work for the client, the owner. So there's one neck to hang.
Yeah, and it's different than, if you've got a $2 million single family home in LA that's down the street from you and you're renting it to tenants. That's
Right.
one level of involvement. I would say that's kind of low level. You do a 1031 exchange into a 100-unit apartment building, that is next level, you know, activity, and it's like herding cats, and
Right.
I don't want to do that. I know a lot of people don't want to do that, and that's where you come in, and that's your role. Is you're there, kind of the intermediary between the person who's the investor, the client, the owner, and all the stuff that's happening, so that they can triple or quadruple or quintuple or 10x their return. So let's talk about a case study. Let's talk about some real numbers and a real deal. I'm super excited to talk about this. Uh,
Mhm.
I'll let you take it from here.
Sure. So this is actually a fairly recent deal, just closed in January. And I keep an active inventory in different geographic areas of all the deals that are happening. So are they on the market? Are they in escrow? Have they recently sold? And there's a lot of legwork that goes through that, but a lot of it is that I have great relationships with brokers, so they'll tell me about deals before they even come out, before they even get launched. One of the important things to understand about how properties get sold by major commercial brokers is sometimes they do what's called a call for offers. I can't stand that. And what that is essentially is where a broker will put a deal out in the marketplace and they'll just collect offers for a month or so and then leverage them against one another. And there's no value for the buyer. In this particular instance, this property and it's pronounced Miami, but it's Miami, Oklahoma. It's a smaller town, 13,000 people, but I'd had my eye on this deal for a while. And it was one of those ones, there's a site called LoopNet. And LoopNet's a free site, which is like the Craigslist basically of commercial real estate. Okay. And so the expensive site is CoStar. So I identified this deal and I started working with the broker. It'd been in and out of escrow a couple times, but it was listed for 3.2 million and it kept falling out. And I asked why. Well, and the gentleman told me he's a farmer part of the time and he's a listing broker part of the time. And he told me, he said, these guys from New York, they keep tying up this property and then they don't perform. What I did was I flew out there and I toured the property. I said, this is a great asset. And it was two farmers that owned it. They had it for 14 years. They really, didn't have professional property management. And I figured out, okay, what's the sweet spot? So we got it down to 2,425,000. I mean, 22,000 or almost 23,000 a unit is unheard of. I think people in California look at that and say, are you kidding me? You bought 106 units for less than $2.5 million. Also, I've got banking relationships out there, so I like to work with local banks out of the state in the area that we're buying because they're hungrier for the business. You're not going to go to B of A. You're not going to go to Wells. You're not going to go to Chase. You're going to go to Chickasaw Community Bank. You're going to go to First National Bank of Broken Arrow, or one of these banks that really wants the business and they may know the asset. And so what we did was we underwrote the deal. And so my client basically purchased this thing and got everything up and running for $900,000. And so our plan, and we're on track for this plan, is within a year, I believe we'll be at a 9% capitalization rate. And we'll talk about what capitalization rate is and what that means to a potential investor. And we examined specifically what's the performance of the asset now. What we figured out, Jim, was that we're the only game in town for 3 bedrooms in that entire city. We raised rents $200 a unit and got no pushback from people. So essentially, the seller just really wasn't looking at what the market would command for these units. And so we're able to add significantly to the revenue. And then we also looked at the expense side, and we're seeing a bunch of different places where we can flatten expense, raise revenue, and create that operational efficiency and create profit. So the goal will be within a few years to sell this at hopefully double what we purchased it at.
Wow.
And and so we're looking at a good, over the course of the next 6 months, a good strong cash flow, as well as the cost segregation piece, which we haven't talked a lot about on this call, but is really where you would use a firm to do a study, and then you would advance depreciate the asset. So what does that really mean? It means that you can realize a lot of the depreciation up front in the first, let's call it 3 years. You're going to get 90% of that load of the depreciation, which means that on your return, you're going to see a bunch of tax savings by purchasing an asset like this.
Yeah, I mean, this is just a 22,000 a unit. That's like rent for a unit in California for a year. I mean,
Yeah, this was a good deal. And there are other ones that are out there. And again, they never get listed, or they get forgotten about, or they're small, or somebody's owned it forever and they've got their wife doing the books, or the husband's is doing the books, and their brother-in-law's mowing the lawns. And I mean, it's crazy that in some of these cities, these deals are out there. And there's other types of assets that I put people into that are much more stabilized. They're newer, there's less fix up. So it really depends on your appetite for risk. Do you want a deal where there's a lot of work to be done, or do you want one that just runs really well and it could just be tweaked a little bit, right?
yeah. And I think, they're different when I think, because I'll meet with clients and they say, I want to do a 1031 exchange. And then when we run the numbers, we find out that the taxes just aren't that much, because for whatever reason, because people think, oh, they hear this number, but there may be some other things going on their 1040. And this is why you really need to be working with your CPA. So this
Right.
is something that it takes a team, and we talk about assembling your A team in, on our videos, and getting the right people to advise you. So sometimes people say, I'm going to sell the property outright, and not going to, because the tax is low or whatever it is. And it's fine for me to sell it. Another one is, a lot of people wait until somebody passes away. And one of the comments or questions, because people are posting questions as we do this live, is, when somebody dies, don't you get a step up in basis and you don't pay capital gains tax? That is true if that asset is included in someone's estate. So if you are inheriting an asset in a B trust, a bypass trust, a credit shelter trust, a disclaimer trust, right? So maybe one parent passed away and now the second parent passes away. Some asset, or the assets that are in those type of trusts, do not get an adjusted cost basis. So even though you may think, you get an adjusted cost basis when somebody dies, that asset has to be included in somebody's estate in order to get that full adjusted cost basis. And when you 1031 outside of California, like we're talking about, I think the biggest problem that people have is they go, oh my goodness, I'm in California and I'm buying this thing in Oklahoma. I don't know what's going on out there. That's kind of scary. And that's why someone would work with you. Then there's the sort of DST, which is the Delaware Statutory Trust, which is, I'm just going to sell my property, and then, that's something you can help with as well on the sell side, I suppose. But
Sure,
they
of
say,
course.
what, this really isn't for me. I just don't want to pay attention to it. And it's a lower rate of return. I can tell you the returns are lower. And then there's kind of an intermediate one where you park money for a couple of years in a building that's later absorbed by a large fund. We're going to be talking about that on our next video next week. So, wow, great content. I'm sure this is high value for a lot of people. If you're watching this on YouTube, please go ahead and give us a thumbs up and subscribe, and maybe share this with people who might benefit from it. And if Jeff, I can't believe you're doing this, because a lot of people watch these videos. As I said earlier, we've had 1 million views on our YouTube page. So there's a free 30-minute consultation. Jeff, this is incredibly generous. What if somebody reaches out to you, they give you a call or they email you, what can they expect? What happens?
So, yeah, and thanks for giving me the opportunity, and I appreciate everybody being on this call. I really like to talk to people one-on-one and get an understanding of specifically what's their current situation with their real estate or funds that they have that they want to deploy in a multifamily environment out of state. So really, it's about understanding their individual goals, maybe from a cash flow perspective, what their tolerance for risk is, and then I can go into more detail about my involvement, what I do, how I do it, specifically Why do I work with certain property management companies or certain banks? And who are the people that I'm connected with in these other states to give them a comfort level that, because it's so far away, how does that all work? And I think, once I talk to the folks, they have a better understanding of how it could all work for them.
And I'm seeing a question here, and I want to, normally we do the questions and don't have, those are not on YouTube, but for people watching this on YouTube, if you have money and want to invest in real estate, you don't have to do a 1031. You can just come in with what we call new money. So if you've got $1 million laying around and you're like, you know what, I want to invest in real estate. I want that $600,000 on our example on the previous slide. I want that $600,000 tax benefit, which means you pay $600,000 less in tax, right? So if you put in 9 and you pay $600,000 less in tax, I'm not a mathematician, but your net at-risk capital is 300,000 to get 10,000 a month. That's pretty good.
Jim, there's one thing I'd like to add is that there's also assets that I already control where my seller may have been in it for a few years and they're looking to move up. So I control real estate that is in good shape that the next buyer can come into as well. So it's not necessarily a one-time thing. And so, what I'm seeing is brokers contacting me right now with there's some rumblings in some multifamily where there's people that are quote unquote syndicators, and you'll hear that term, where a bunch of money is cobbled together and you really have no vote. But when you're a single owner, like you said, you can buy and sell as you choose. And so what I'm getting now is deals that were underwritten incorrectly by syndicators who just basically scooped up a bunch of money, promised a return. It didn't happen. And now those properties are gone into receivership. I get calls from brokers saying, Jeff, I have a 50 unit deal. It's $1.2 million. It's in this part of Oklahoma. If you have a cash buyer, bring me them now. Let's put something together. And they're working with the bank. And so years ago, I did lots of short sales, foreclosures. I'm not saying that there's going to be a ton of that, but there is definite opportunity for people that want strong cash flow, tax savings, someone to manage it for them. And then in this consultation, I'd be able to go through a lot more detail about how that works.
Well, great. So we have offices in Northern and Southern California. Jeff, you are in Orange County, but you're available by phone and Zoom. And I'm assuming that's how probably all of your meetings are now. It's kind of like the way
95%. Yeah.
Right. So next week, if you are watching this webinar, go to our website right now and register for this. This is great. This is called an UPREIT. This is a 721 exchange. It is where you say, you know what, Jeff, what you're doing is great. That's just not for me. Now, the return is not as sexy, but there's significantly less involvement. And this is really great if you have real estate and you want to pull some money off the table from that real estate or stretch out the realization of the capital gain over several years. So this is really, I would say, a real estate exit strategy. And what Jeff's talking about is continuing to be in real estate and to create intergenerational wealth. So this is more of an exit strategy for real estate and pulling money off the table. But that is next week, and we'll be doing that with Ascent Wealth Management. And we will open it up for questions now. If you are watching this on YouTube, Jeff, thank you for joining us. Just keep watching YouTube because it's going to roll up to the next video, and we will see you next time. All right. We'll go back. So I've got your information for the firm. Jeff, how do you get paid? A percent of rental income or flat fee?
So yeah, I'm happy this question came up. So there's several different pieces of fees associated with this. So in the actual purchase, I get paid an acquisition fee. The acquisition fee is 2% of the purchase price. Also, there's a due diligence fee. Essentially, what I'll charge is $125 per unit for the inspection. So if it's 100 units, I'm getting paid $12,500. But what I do is I go investigate every single unit. A lot of times when investors will buy a large property, they will only do a percentage of those units. I don't believe in that. I believe you should go through every single unit. In the case study example that we went through, the community manager, the person working at the property for the seller of this property, I asked them, I said, do you have any work orders? And they said, no, we're all caught up. And myself and the buyer went through every single unit. We had over 300 work orders of things that needed to be repaired. Why is that important? Because not only are you going to do a true inspection with an inspection company, but I will personally go through every single unit and go through a checklist. And that's important because you may have the opportunity to renegotiate if you find things where units are just really beat up or you've got health hazard things. It's just better to know everything. And the feedback from the client was that was the best money I ever spent. And so that's the due diligence piece. Then with ongoing management of the asset, there's 25% of equity and there's 25% of cash flow or a flat fee. And why I say, well, which would it be? It really depends, because if a client is purchasing a property cash, I may charge a different amount than if they're getting debt on it, because the cash flow may be less. So I'm not going to crush that deal with how I help them with it if they put a mortgage on it. So we work that all out at the beginning and make sure the client's comfortable with that. So when you say equity, the reason I get a percentage of equity, and that equity, by the way, is not they pay for the property and then I get equity up front. It's from the strike price of the purchase to the sale. So why is that important? Because I'm incented to make sure that the place runs well. I'm incented to make sure it sells at the highest amount when they sell it, because I have skin in the game. I'm also incented to make sure that property management does their job and make sure that if you give property management a budget, they're going to spend whatever you give them to spend. And so it's having somebody that has a knowledge and the eyes on what they're doing to make sure they're optimizing the revenue and they're keeping expenses to a minimum while still running the property effectively. And then on the other side, what I'll do is I will assist the owner in selling the property at whatever time they want. But what I may do is they may hold the property for 2 years and I may say, hold on to it for 10. This thing's running great. Typically in syndication, Jim, what they do is they have a cycle, a 3-year cycle, a 6-year cycle. And so sometimes you're not selling when it makes best sense in the market. You're selling when it's good for the syndicator. And that's no bueno. I believe that you should sell when it's best for the owner. And I may come to the owner and say, look, I got 10 unsolicited offers. We're going to crush it. You should sell. Or I may say, you know what, we're rolling with this thing. It's going well. Let's just hold on to it for now, because it's to my own benefit. So because I'm aligned with the seller's income and also with their strategy, it tends to work out really well.
Yeah, and it's kind of like a private equity, the 2 and 20 model
Yeah.
into that. It's really similar. So if you're familiar with
Sure.
how private equity works, I would say it's similar.
Mhm.
Steve asks, if I had $1 million cash but no 1031, would Jeff just arrange the purchase and manage my property in all the ways he describes? And that's what you did in the example.
Absolutely.
Same exact thing. That was new money coming in.
A
And
100%. And what I would look for is a deal that basically fits that size. So if they wanted to buy it cash, well, what does that look like? Or if they wanted to have a mortgage on it, say, okay, we could take that $1 million and maybe we take 600 of it and we put it towards the down payment. And then we take this portion of it and put it towards improvements or to the setup. And so that $1 million would be all in. So I would look to identify assets that fit what the client has to work with.
well, great. So we have offices in Northern and Southern California. Jeff, you are in Orange County, but you're available by phone and Zoom. And I'm assuming that's how probably all of your meetings are now. It's kind of like the way the
95%. Yeah.
Right. So next week, if you are watching this webinar, go to our website right now and register for this. This is great. This is called an UPREIT. This is a 721 exchange. It is where you say, you know what, Jeff, what you're doing is great. That's just not for me. Now, the return is not as sexy, but there's significantly less involvement. And this is really great if you have real estate and you want to pull some money off the table from that real estate, or stretch out the realization of the capital gain over several years. So this is really, I would say, a real estate exit strategy. And what Jeff's talking about is continuing to be in real estate and to create intergenerational wealth. So this is more of an exit strategy for real estate and pulling money off the table. But that is next week, and we'll be doing that with Ascent Wealth Management. And we will open it up for questions now. If you are watching this on YouTube, Jeff, thank you for joining us. Just keep watching
Thank
YouTube
you,
because it's going to roll up to the next video, and we will see you next time.